Joshua Negrera. I am the acting director at the Center for Real Estate Finance Research. We're thrilled to have Marco Soriano here, who's the CIO of Soriano Family Offices. He wears many hats, so I'll let him introduce himself a little bit further, but he has a ton of creative and innovative ideas in the space of cryptocurrency in hospitality. He's been a driver of tech innovation in hospitality, keyless entry, a whole number of things, but I'll let him introduce himself and he'll give us a great update on the hospitality sector in this day and age. So I'll go ahead and mute myself, and thank you, Marco, for joining us.
Listen, always a pleasure to be able to give these seminars virtually, especially these days. I give a little bit about my background. I've been in this rig for about 20 years. I graduated from NYU in 2001, and then I went on and did my MBA in 2009, where I graduated. Tough times, as you can imagine. You know, we had 9/11, and then we had the economic downturn, and now we have this pandemic. So a lot to be learned in this whole period, for sure. What I did was consolidated our family assets into in a structure that today everybody's calling family offices. You know, so it's a family corporation going into different trusts, accounts, where you can handle asset allocation and portfolio management. The most recent development that we did with this was ingrain ourselves with Merrill Lynch, Bank of America. You may hear this where family offices actually manage their own teams and they manage their own costs and expenses. To me, it was more of a really a test to see how I can leverage Merrill Lynch, Bank of America's infrastructure to my advantage. And so far it's working out. We do have a very good deal with them, where they'll get 40 basis points out of everything that we do in the global wealth management side of it. What we've created with these vehicles are basically verticals where we can invest in alternative investments, and that diversifies a little bit more just your standard stocks, bonds, munis, retirement, pension funds, whatever it is that people like to do these days in order to be able to have money for the future, right? So that being said, and I got one of the principles here. We started about, I would say, 13, 14 years, Urban Commons, which is it's not a fund, but it's a company that specializes in hospitality. The hospitality sector, as you already know, is always the first one to get hit during any sort of crisis. And this is something we've learned for decades. So what follows that, and we're seeing that as well, is commercial real estate, and then residential. And that's kind of the steps, and usually happens because of the way the economy works, right? People lose their jobs, people start vacationing, traveling, then it goes down to not being able to pay your commercial rent if you have a business that is going out of business, and then down to your personal, which is, you know, you have to feed yourself before you pay rent, especially in big cities where rents could be extremely expensive. And you guys are all aware of that in New York City. So all of that happening now, which has already been almost a full year, we have seen this type of behavior. You know, we saw it in 2008, and that lasted almost about 5 years, in which time we started positioning ourselves very strategically. Because as the prices start going low and low and low and low, we start seeing bigger discounts. This is the opportunities to go in and buy. So not everybody does it in the very beginning. Everybody is very bearish. Nobody really wants to take the chance. Everybody's, and you're seeing all of this because none of us really understand the level of uncertainty that this pandemic has created in the real estate sector. Very few people are very bullish, and that's where we come in. You know, and we like to sort of repeat the same recipe that we had back in 2008 to produce the returns that we had today. We are about $1.3 billion just in real estate assets. We're the asset managers. We hire third parties. We like to buy specifically nationwide well-known brands such as the Hiltons, Marriott's. Here and there, we'll buy a Holiday Inn. And New York City, since you guys are all, most of you guys are from there, studying there right now. We own the former Ritz-Carlton downtown Manhattan in Battery Park City. And we renamed that the Wagner Hotel. And it's going, it's going well. What we've learned from this pandemic is that you don't have to be at over 70, 80, 90, 95% occupancy rates, that you can still have a very good earning, especially with all the support that we're getting from the government at this point with the PPP, is that 45%, we're still doing well. And that's kind of where we are right now. So the biggest mistake that I think I've seen out there is the expectations that these discounts, which are anywhere between 15 and 20%, will go deeper, right? And they're expecting that because that's what we saw back in 2008, where we were able to see discounts that were 40, 45, 50% in some places, in Europe, 55%. So this is unlikely. We're not seeing that. I don't think this is going to get any worse unless everything that's happening around us, having a vaccine already present that is going to be distributed to the US and many countries in the world, will most likely reopen traveling, which is going to help the hospitality sector to rebound back. And then that in effect will be the next step, right? Commercial, residential. The big question remains, everybody's getting used to working virtually from home, and you're able to get a lot of things done. There's no question about that. The issue will always remain the human factor. We need, especially in the business, you need that one-on-one. You need that interaction. When you're buying a building, you need to go and inspect it. You need to go and take a look at it. You need to really sit down and get dirty. It's not a virtual buy where you don't buy a hotel for 100 million or more, which is typically our ticket, and no go there physically to see what's going on. So these are some of the challenges. These are some of the trajectories that we have taken. One thing that I would recommend you guys is always to be able to adapt, and adapting was mentioned, technologies in the technological platforms or technological sectors that you're looking at into hospitality. All of you guys are participants of this. The way you make reservations to your restaurants, the way you make reservations for your hotels, your flights, everything is typically online. Unless you're still very old school and you're calling the local agency, travel agency around the block in your neighborhood, but that business is really gone. So today, what we're also doing is not only identifying which are these companies that are basically the underlying foundations of how we're getting our clients, how we're attracting our clients, but we're investing in these companies. And we've created platforms to allow access points, right? Now, with access points comes the next question, which is loyalty. Nationwide, well-known brands don't really have much of that issue, right? Like when you're looking at a Marriott, at a Hilton, and I'm sure some of you guys have been staying in these resorts or hotels whenever you're traveling, it's automatic. Is in your subconscious, is you're going to go to this hotel and everything is going to, what to expect. That you're not going to have any surprises, any tricks or anything of the sort. And that is one level of loyalty. The second level of loyalty that a lot of companies today are incorporating or have been doing it for some time is reward points, right? You go and stay in an SPG, which is now part of the Marriott. You would earn points as you spend money. What happened during the M&A that took place 2-3 years ago almost, when Marriott acquired SPG, they reconverted all of those existing reward points of almost 20, 30 to 1. So a lot of people were very upset. you know, because that has spent for a long time with SPG. When you're looking at SPG, you know the hotels, right, you guys? We're looking at the W hotels, we're looking at the St. Regis's, we're looking at all of the top level, except the Four Seasons, because that's a part. So A-lofts as well. So what happened with all of that is that they started losing clients. You know, they did this conversion on the loyalty programs, and then these clients were like, well, why am I getting one for every 30 points that I had earned over the last God knows how many years of being a client of yours? So what we're doing with this to resolve this issue ourselves is we've integrated a cryptocurrency platform where we've created our own crypto point. We're offering that as a reward point, but we're not only offering that to the traveler, we're also offering that to the hotel owner for simply transacting with it, right? So we started out giving it about a year and a half ago. We have about $30 million worth of this cryptocurrency out there. There's a lot of different elements here to take into account. One is, you know, it's not just a transactional volume that you can create within your infrastructure when you have hotels and clients, but it's also that secondary market that you're aware of. It's very speculative, right? So how does this two connect? And this is where we have held ourselves from listing the coin onto a secondary market where it's just going to be speculated upon. And instead, what we're focusing is on distributing this loyalty program, this cryptocurrency to both parties, right? The hotel owner that accepts the payment in cryptocurrency, and also the traveler who is actually using our platform to book anything they want. And this goes back to what I was saying initially. Today, you go to all these different platforms to book just about anything you do in your lives. So this is kind of connecting the dots and all these sectors so that it complements us, complements our clients' experience, and it reduces our cost as asset managers to these assets. So, you know, I'm going to start with questions, because I know you guys may have questions in your mind, and I don't want to go on and on and on and on and make you go to sleep. So why don't you start asking some questions? I do have Taylor Woods on the line. Maybe Taylor, if you don't mind introducing yourself and giving them a little bit more perspective on why we're so bullish in the market even today.
Sure, happy to do it. Can you hear me now, Marco?
Yeah, so you know you're addressing New York University Stern, and I think undergrads interested in learning in the real estate sector.
Very good. So everything Marco just said, just follow that pattern. You guys will be very successful. Now, so our focus in hospitality is it's proven to be very, very successful for us. We as Marco described, the downturns in 2001 and 2008, and here now, what those downturns have done is created massive opportunity for us. And what we envision in this cycle is just the same as what we saw in the prior two, and so we're taking advantage of that. We're buying and we're bullish, and we focus on markets that performed previously at a very high level, and we are making acquisitions what we believe is ahead of the capital that's on the sidelines that will come into the market over the next 24 months. 2020 has been a little bit quiet. Most of the money on the sidelines has stayed on the sidelines. So in 2009, for example, we bought a few hotels in 2009 and early 2010 that by 2011 and 2012, those not only had those markets fully recovered, but were setting peak records, and there were also peak pricing on sales. So we actually divested all of those assets in that same window. During a more normalized period, 2013, 14, 15, we were making acquisitions of properties that needed some capital improvements, some expansion, some brand upgrades, some renovation. That's a little different model, which is also very interesting to us and can be very successful. But it does take a completely different shift in focus. So at the moment, we're making big bets on properties that may still be performing well below 2019 levels, but we know by second half of 21, 2022, and worst case scenario by 23 or 24, they'll be normalized, stabilized, and potentially outperforming the prior peaks.
Right. He's saying something very, very interesting, because this whole period or expectation of normalization is when we see the exit, right? That's when we start now in a very bullish way, where the amount of bidders to any asset that is available are very minimum. So you're not really competing with when everything is normal, which is what most people would expect, would hope to start buying. So at that point, it's kind of like an arbitration, right? You buy it at a discount and then you start selling apart when everybody thinks it's normal. But at that normal point, everybody is game. This is when you have to compete with 1,000 bidders, and the process of buying an asset takes much, much longer. During a period of time like now, I'd say in record time, we probably have completed successfully an acquisition within 6 weeks. In times like now. In times where normalization is already in place, it could take up to a year. And that's where it becomes expensive, because the deal can go sideways if it's not properly catered. And this is a human factor, right? This is a human factor. It comes down to your relationships. It comes down to your negotiations and your word, right? If you got the money to really back up what you're saying, and if you have the asset to back up what you're saying, and whoever is the middleman, typically your institutions or any private company that is actually leveraging you in the position, giving you the loans, then that's a whole different story, because there's a whole different relationship. So there's a lot of elements that move around that during a time like now, they're easier to handle because of the time, the time period that I mentioned, as opposed to when things are normal or everything is premium. So take this as a, with a grain of salt, because it's really 20 years that I've been doing this. I know Taylor's been doing it for a little bit longer because it's a bit older than I am, and we have done it successfully, right? And looking at all the angles, what are the underlying foundations of all these different companies, how they're operating using technology. Always learn about that. Always stay on top of that. So why don't we take questions from you guys, and hopefully we can address some of your most personal concerns.
I can get things kicked off with a question here. Marco and Taylor, thanks for being here. You guys seem to be very high conviction in terms of your acquisition strategy right now. I would just be curious to know, what factors do you look at to get to those conviction points, and to kind of get to that point that makes you feel comfortable kind of entering and making an acquisition when you don't maybe know how, when you're trying to kind of catch a falling knife in a sense. I know, Marco, you spoke earlier about assets were 40% of discount, now they're at maybe the bottom they'll hit is 20. How do you get to those points to where you can definitively feel comfortable making that, I guess, that big timing decision? Sure.
Taylor, why don't you guys this started, and then I'll wrap it up so that
Sure.
Insight.
So this is a very good question, because nobody can predict the future. Nobody can tell exactly what happens. No one knows exactly what the ultimate outcome will be, right? We're relying on our government to provide vaccine. We're relying on and industry, and vaccine producers and distributors and everybody. We're relying on that. We're relying on the sentiment in the world to return to a state of normalcy. We're relying on people leaving home again and stop staring at their screen so they can actually see what it's like to meet in person and get the kinks out of their neck and the strain out of their back and actually get business done in a more traditional way. We do rely on all of those things in this particular cycle to happen, but industry is cyclical, business is cyclical. There have been similar pandemic type events that have happened globally in the past, and they do disappear and they go away. And even if we never had a SARS vaccine, it's gone. It didn't create a problem that was lasting or permanent or caused the world to crumble. So we see these cycles, and you see peaks and troughs, and we're not trying to time those. We see this as buying property that we would not have normally seen or had an opportunity to buy, that we know was producing very well, had very large demand drivers. So there was very good business from multiple sources, multiple channels, whether it was convention or tourism or sports or whatever drivers there are that certain markets carry. For example, we're buying in Nashville, which has it's a year-round market. There's a ton of business and entertainment and convention and tourism. We're buying in Seattle, which has just massive growth in tech and has just continued to be a phenomenal market for the last year, on top of the last decade. So we're making a bet, and we're betting that the property that we buy today is going to be worth more tomorrow, and only looking at the past for proof of that. And if we're wrong, I think we'll be surprised. We could be wrong. In 10 years, we could all be sitting in our house on lockdown if everything stays ugly, and there are worst case scenarios where the virus comes back and we all get it every year, right? So there are some of those scenarios that could play out. We don't tend to believe that that's likely based on other events that have happened. Marco?
Yeah. And the two hotels, the two cities that our strategy is always to look in capital cities around the U.S. We're very U.S. centric, and as I had mentioned, we always look at nationwide recognized brands. So we're buying top of the line. These two specific areas have been developing cities, growing cities in terms of jobs, opportunities, in terms of per capita income per capita. So we're looking at all the different economics, just the same way you would do when you are setting up your own portfolio, right? And asset allocation is extremely important when it comes to them, in terms of debt ratios and debt coverage ratios, to see how responsible, what is the attitude of the people that live in these cities, right? And that being said, I think the strategy is pretty straightforward. You work with hotels that have already proven a concept of managing their properties as they should. So we're looking at properties that are over 95% occupancy rate. So these are like the cherries of the market. And whoever is looking at them, it's doing the right thing, because the cherries of the market, when the market normalizes, are going to still be the cherries of the market, right? If you start buying all of that overly discounted property, and then you're taking a higher risk, because it's like in investments in the markets. You have investment grades companies, as well as, or stocks or bonds, as well as speculative. So these overly discounted properties, to me, it's already over speculative. So we tend to stay away from that, so that we can do a better job in our returns. What we've done also differently, and I hadn't mentioned that, is we actually built and put together a REITs. And for those of you guys studying finance, of course, you know what a REITs does. gives you access public to money, where we had taken a block of our assets that we own, that we were managing, and we placed them under the REIT right now. So out of our 23 hotels, we have about 16 into this REIT. It trades in Singapore, and it has given us more branding, if you will, or more exposure to public investors as well as private investors. And now when we do these acquisitions, it's just a matter of, picking up the phone, explaining to the investors that have already probably invested with us or will be investing again with us, that what we're doing and why we're doing it again, right? Even though it's been 10 years since the last big opportunities we saw, and everybody is in our sector is always waiting for this type of crises to take place. It sounds horrible, but it's really the game that we play in the market. Nobody likes to pay premium, and if you do, then I think you're studying at the wrong university. In that being said, this is how we position ourselves. This is how we have been doing it for almost 20 years, and successfully saying, we do really well. Our average returns vary 17-23% a year. On assets, I think it's maybe anywhere from, depending, it could be 8 up to 13. And we had our great years, great exits, and this is what we're trying to build. We buy low as it could be acceptable, and then we'll exit when things are normal. Any more questions? Josh?
I've got one. Thanks again for being here. I'm curious, you kind of touched on it a little bit, but either from COVID or from technology, can you talk about the changes in operating these hotels and what you're seeing? I know like contactless check-ins are becoming a thing because of COVID, but curious kind of what you see emerging over the next few years.
All right, so here are facts that people don't really know. When you're running hotels, the current infrastructure is what you probably already know, right? We're looking at Booking, Expedia, Trivago, all of these different companies that are advertising the best vacation in your life, in quotes. These companies, depending on where you're located, could cost us per reservation anywhere between 20 and 40%. Now, these are commissions that are extremely high and expensive to the hotel owner, to the asset manager, to the operator. And they have become so huge in the industry that if you have a hotel and you don't have them, nobody will find you, right? Because it's all algorithms. And so that changed a lot, this whole industry. Most hotel owners, nobody ever takes into account who you're going to use for a reservation channel, and then you have multiple of them. So now, how do you control all of this information? So there came about another technology called channel manager, and the channel manager basically centralizes every single one of these sell channels. So now you have to have a team just for that. If there's any type of advertising, any type of discount, last minute discounts, then you have to use that. And then came Hotels Tonight, right? Which I'm sure is one of the apps that you guys are probably using the most. And then Airbnb. So all of these different technologies started competing with each other, but taking away from our market share. And here is the guy who owns the fancy Ritz-Carlton downtown Manhattan that has nothing to brag about in technology, simply because we're dependent on these guys. And if you don't work with them, well, try and find somebody to find you if you have a hotel that doesn't have a name that is recognizable to the consumer. So this is why we're also staying in the top tiers, the well-known hotels that already has an infrastructure that sort of supports that given consumer sector for yourself. So it's very tricky, and it is extremely important to know what are these technologies that are being used. On the other hand, you have the payment systems. What are the payment systems? How is it that the dollar gets to you? And these companies, once again, and many other integrated technologies, which are just payment systems, are ingrained there. So by the time the dollar goes through all of this cycle and gets to your bank account, it's already probably close to 50% below. So why not invest in these technologies? Why not invest in the technologies that will be eventually vertically integrated onto these platforms so that you are part of this cycle, right? A lot of hotel management companies, a lot of hotel operators, a lot of developers, they don't even think about this. And I can tell you from experience with my own family, they don't care. But we should start caring, because that's part of our bottom line, period. Or you reinvent yourself. You invent your own platform like we have. You invent your whole loyalty program like we have, and you start tapping into technologies that are today common to be heard of. You hear about Bitcoin, the value of Bitcoin. That's a secondary market. Shouldn't matter to you. It should matter to you that if you have a primary market access point, that cryptocurrency could be accepted as a form of payment, and that once you have that crypto, that you have the decision: redeem it, right? Cash it out to whatever currency you need, whatever in the world you are, or hold it and speculate in the market because it may be in your favor, right? That one room that somebody pay you in crypto for $100 may become $10,000. So question remains, right? Again, how much can you do of that? Am I telling you guys, if you run a hotel, do 100% cryptocurrency? No, you can't do that. You can't do that. But there's maybe 5%, 10% that I play with personally in not only hotel business, but also in some of the manufacturing companies that we own. For example, we brought back the manufacturing of one of our old legacy assets, which was a motorcycle business out of Europe, and now we're accepting payments in cryptocurrencies, and we're using Shopify, we're using Coinbase as the platforms, which I had invested 10 years ago when these companies were just were being introduced to the market. So these are opportunities. These are the angles that I'm referring to when you are operating. You have to look at it, everything panoramically. You can't just focus on the one asset and not think about what is actually costing money to go through it and creating that cycle. Any other questions? Thanks, Nick. Good question.
Can you tell us a little about the legacy motorcycle? I know it has an interesting history, a family history. Just curious if you could go on about that.
Yeah, cool. That was about, actually, Taylor, who's on this line, is also one of my partners, because we now, once you develop these relationships, you start what we call in friends and family rounds, and you start commingling money and start investing in different things. So around the 1930s, the Soriano brand was manufacturing cars, racing cars, the classic cigar-shaped cars and that brand was being manufactured out of Paris, France, and southern France. Died out, 1920s, right? I was born in 1980, so this is just part of the history of the family. 1930, 1940, 1950s, motorcycle became the business. And this is just around the time where two-wheel mobility, especially in Mediterranean countries, became the thing, right? You went from, if you could afford your car or racing car at this point, to being able to have your motorcycle. And today that's part of the culture in Mediterranean countries. In the US, it's more of a lifestyle. If you have a motorcycle, it's more, you don't use it really for commuting. You use it more for the weekends, to hang out with your friends, to show off, whatever the case may be. What we saw is, once again, another trend, and you guys may be already been thinking about this. So I created a company called Soriano Motori, which is Soriano Motors. The motorcycles we used to manufacture out of Spain, the cars out of Paris, and now we're manufacturing out of Italy. So I just kind of completed the circle, basically, where all my family spread out. And we saw the trends of EVs. Tesla paved the way. Today, this company's valuation is, it's out of this world, right? It's over $400 billion. And we thought of bringing back the brand, the family brand legacy, and play a lifestyle, add a lifestyle touch to it. What I'm intending to do is buy real estate, create clubhouses around the world, so that if you're a bike owner or if you're a member of the Soriano Club, or we're calling the Soriano Club, you'll be able to have access. Once again, it comes down to access points, right? And so in these clubhouses is take what the Soho House concept has done in the world and multiply it by 10, right? Because now we're gonna have a showroom. I'm gonna have a fashion line that meets engineering, is what we're calling it. We're gonna have a foundation that is going to be sponsored by universities worldwide, where engineering and fashion companies come together. So kind of teaching how that connects. The real estate factor is there. And the hospitality factor would be with having a rooftop terrace, nightclub type of case scenario with a nice restaurant in it, but not as the owners, but the asset managers, right? I'll rent it out to somebody who actually knows how to do that, because I just know how to party. So that's it. This is kind of like the plan. We started out with developing this motorcycle. We developed 3 models. They're already out and about. They're nicknamed as the Tesla of motorcycles, the Ferrari of motorcycles, and all this. All that is great. However, not that I want to be free advertising all those other companies which are already well known, you know. But it is flattering if you are being compared to the top players in the market, especially the fact that we had a history of doing this throughout Europe, and now we're doing it in the US. Even though we're manufacturing out of Italy, we're managing the headquarters is in the United States, and it plays out with all these different elements. Once again, technology, real estate, entertainment, the whole multiple sector approach. It's really the strategy that I think today companies have to have if they want to be more successful. You know, it's catering to the new generations, which is always looking for access points. The fastest, the best, the beautiful, whatever it is, that's what you got to offer, and that's what you got to put in the market as a platform. So if you want to buy a motorcycle, let me know. I'll give you a good discount. Any other questions?
Hi, Marco and Taylor. Thank you so much for visiting with us at Stern today. A question about your investment philosophy for the distressed hotels. Do you have a typical time horizon for holding the asset? Is that part of your philosophy in general, or is it just a case by case in terms of your holding period?
Sure, holding periods. Why don't you let me ask if I still have Taylor. Can you talk about holding periods? Because I know that varies.
Happy to do it.
Go ahead.
Yeah. So in those 2 kind of broad categories that I described, one is in a kind of an immediate downturn like the one we're in now. We're buying properties that are fully renovated. They were very strong performing historically. We actually see those as opportunities to buy very, very strong properties that will have a lot of appeal to a lot of people. And in kind of without having anything too predefined, we think that within 2 to 3 years, those have been sold to the $1 trillion, in this case, that's on the sidelines, that's going to be looking to be deployed for income generating assets. In the cycle where things are kind of normalized and we're creating value and we're spending money and we're doing renovations and we're upbranding and upgrading property, we may take 2 to 3 years just to complete that process, and then another year or 2 of stabilization. So that kind of becomes more like a 3 to 5 on a simple project, or a 5 to 7 year hold on a more complicated project. In fact, we do some ground up development, so those kind of fall into that 5 to 7. So we just sort of shift, and sometimes that's property by property. We could always buy a property today for very, very cheap that's been run down and mismanaged and undercapitalized. And then we would have 2-3 years of kind of improvement and stabilization to do, and then another year or two by the time we would sell. But we're sort of opportunistically looking at property that is in the kind of condition today that you'd have 100 potential buyers looking at it in 12 months or 24 months.
Yeah, absolutely. Building, renovations, construction, that hasn't stopped. It doesn't matter where you're looking at, it's always happening. And that's a good sign, right? That this pandemic hasn't stopped it, especially down in places like Florida. Now you have an exodus of New Yorkers to Long Island, to South Carolina, down south, right? Everybody heard of it. So there's a massive move of construction, new development happening just in the residential sector alone. The question is still, it remains about commercial, right? Commercial, because for example, in our case, we're at 57 Rockefeller Plaza, which by the way, any of you guys can ever want to visit when we open the offices, I'll be more than happy to buy you out for lunch and have a more private conversation. I've always told Josh that my doors are open in my offices. Home is a bit of a mess. So, but in the offices we're paying, for the one floor that we've got, I think close to about 1.5 million a year. And we're locked up in that agreement for the next 15 years. So, and that's just one floor out of the building that we have, I think maybe 25 different floors. So you can imagine how much money is being bleed right now when nobody's using it. But our skeleton management team is there, our IT department, our infrastructure is there, so there's a lot of things that keeping the offices open, even though there isn't anyone in them, it's needed. It's needed, and we can't really walk away from that. But once again, the question still remains: is commercial real estate going to go away? No. And I can tell you that because we're locked for 15 years. So I think in 15 years there's going to be a solution to what we're seeing. So I don't think that's going to go away anyway, no matter what people are thinking in terms of being able to work virtually or not. So any more questions, guys? This is your time, guys. This is your time. Come on, just put them on the table.
I'll ask one on behalf of the students. Are you taking on any interns, any full-time roles coming up at any of your companies?
Are we? I just got a couple of interns for the family office. Taylor, are we doing anything with Urban Commons for interns anytime soon?
So we've done this from time to time. We're open to it. We're in Los Angeles. Our headquarters is in Los Angeles. We have property throughout the country, but Los Angeles can be an attractive place for people that have been in cold winters for a couple of years to like to visit. So we're not that large to have a formal structure, but if someone has an interest, we just take it case by case.
We could. No problem. We'll look at it. That's for sure. I mean, how many people do we have now, Taylor, in the office? 25, 50?
Yeah. We've always been around 40, 45, 50 total staff in office, and then our third party operators manage hotels with another 5,000 or so people, but we're that's property level.
Yeah. So this is how we conquer the world, right? He's in the West Coast, I'm in the East Coast, and sometimes we meet in the middle. But my main office is on 57 Rock, and then these guys are in Los Angeles downtown. So whenever you guys want to come and visit us, that's you're more than welcome. Any more questions, Josh?
I'll jump in with one quick one. So thank you guys for sharing with us. We've learned a lot already. So you talked a lot about kind of a lot of technology and future thinking ideas. I'm curious for your thoughts on kind of how environmental aspects will play into all this in terms of energy, construction, and how you guys are thinking about all the kind of innovation and development and potential PR things there in the future.
All right, so you're talking about from building these hotels that we're buying are already built, right? So some of them have been built in the 80s, 90s, anything before the 80s, the 90s, for sure, you have issues with the HVAC system, you know. So what we've done throughout our family office is created a engineering commissioning group. And the engineering commissioning basically does all the testing of everything you need to do, that the engineers, the architects, and whoever else is involved in that process of the new development is involved. So we make sure that and you've seen this, right? So you're looking at water quality, water balancing, air quality, and electrical outputs, right? And you're seeing buildings where probably where you live, one of the outlets just doesn't have any type of conductivity of electricity whatsoever, right? Doesn't matter where you plug it, how you plug it, just doesn't work. So these are issues. These are issues that happen often in old buildings, new buildings as well, because, you know, you get your GC, and that GC goes and hires subgroups that there's no quality control. So to bring quality control, it takes time, it takes a team. So we usually always place an engineering commissioning group that will go in, take a look at the material, test everything that is being done day in, day out, reporting directly to the developers, to the owners of the asset. That's one approach. In our factories, for example, where we're manufacturing motorcycles now, and there's a lot of moving pieces with suppliers that bring me pieces from all over Italy now, it gets a little trickier. I haven't done manufacturing per se myself directly, but you know, we're trying to maintain as much quality control by working with the suppliers within 20-30 kilometers ratio rather than anybody else. You did touch base on something extremely important, which is energy. You know, any type of new energy today is extremely important, because batteries is going to be the main source for electric vehicles. So as we are seeing a surge of demand for electric vehicles, especially for this decade alone, by 2030, oil will reach its peak. So electric vehicles are expected to increase in value. You can see all the big brands in the world that are manufacturing either cars or motorcycle doing some sort of version of an electric vehicle. So it is transitioning, it is happening. And batteries, well, you know, the type of batteries that we use today are either lithium ion or lithium polymer, right? You have to ask where they coming from and who are the companies that are selling to you from that. That's just a little tip in case you're invested in this sector.
Yeah, thank you.
Yeah. Anyone else?
All right. Well, I want to be respectful of your time. Thank you so much, Marco and Taylor, for speaking to our students. I'll check in with you after, see if it's okay to release your contact information, or I could have students send emails towards me. Thank you again. Incredible information. It's good to see how you're running the companies, and we look forward to hearing more on what you're doing in the future.
Yeah. I think that's what you were referring to, all these different hats, right?
Right.
You don't see it, man. It just happens. It's one hat after the other, At the end of the day, everything is connected. I think what's really most important here, if you guys are married and you have children, is that you do dedicate time for that, because the work that we do is very time consuming, and it takes you away from your family. So this pandemic, in a way, and some of you would agree, has improved my quality, my marriage, my relationship with my kids, and my work, because it's kind of got the perfect balance. You know, in the past, I would leave 5 a.m. and I would come back almost by midnight every single day, 6 days a week. So it's a good time for reflection. It's a good time to learn new things. It's a good time to stop and look at the trends, the patterns, and try to connect these dots. But this is something you got to train your brain for. You know, it's not something you would learn at the university setting. Forget it, because there's a lot of theoretical stuff. But yeah, talking directly to the alumni, the alumnus that have done this and are doing still quite all right. It's a key element. So I appreciate Josh for inviting me, having these students learn a bit more about what we're doing, how we're doing it, and hopefully some of the information that I've given you guys will help you in your decision-making processes in the future. So thank you and enjoy the rest of your day. Thank you, Taylor.
Thank you again. Appreciate it.
Thank you.
Yep, appreciate it, John.